All right, stocks ripping higher after an upside surprise on payrolls with 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, that blowout jobs report denting expectations of another big Fed rate cut next month, and U.S. dock workers ending that three-day strike. Work resumes today, along with negotiations on a long-term agreement. We've got it all covered with an all-star lineup ahead, including Acting Labor Secretary Julie Su, Chicago Fed President Austan Goolsbee, and BlackRock's Rieder. Let's take a look at where markets are trading, of course, after those numbers that we got at 8:30 a.m. A lot of good news on the screen behind me. Of course, the S&P 500 shaking off the declines of this week, currently up about 0.9%. Of course, big tech faring even better right now in the pre-market. The NASDAQ 100 up about 1.3%. The bond market, meanwhile, we are knocking on the door of 4% when it comes to the 10-year Treasury yield, currently up about 9 basis points.
We're going to watch some stocks under the surface now because there is some movement. Rivian shares tumbling more than 7%, 7.4% pre-market after the EV maker cut its production guidance for the full year due to supply shortages. More on that later in the show. And Spirit plunging today as months of talks with bondholders failed to result in a deal to restructure its debt, according to sources. Brutal decline here, more than 33%, Katie. Also, watching shares of Summit Therapeutics up more than 12.5%. It said the FDA will fast track its lung cancer drug for use for chemotherapy.
All right, let's get back to the big story. That is September job growth topping all estimates with its largest advance since March. You also saw the unemployment rate unexpectedly decline, easing concerns of deterioration in the labor market. Let's break it all down with Mckee. He is Bloomberg's chief international economics and policy correspondent. A lot of good news here, of course, when it comes to the headline payrolls, when it comes to the unemployment rate, when it comes to revisions as well, an upward revision.
Everything good. I mean, this was quite a surprise to everybody. I was telling Katie a minute ago that it reminds me of Phil Rizzuto, the Scooter, the old Yankees announcer, who used to say, "Holy cow," when something amazing happened. And that was kind of the reaction of everybody on Wall Street today, I think. The number of jobs created, 254,000, the highest, much higher than anybody anticipated in the Bloomberg survey. The revisions, as Katie mentioned, up 72,000. The unemployment rate falls. And take a look at the next line down. 3-decimal unemployment, 4.051%. And that is 2/100ths away from basically being rounded down to 4%. So that is an amazingly strong number. Participation rate unchanged. The labor force did not change all that much, rising just by 150,000. So this is not a story for unemployment of a whole bunch of aliens coming into the market. Household employment just rose a lot, 430,000, while unemployment fell a lot, 281,000 hours worked off just a little bit. But the important thing is going to be this unemployment rate, because we were at 4.2%. The Fed's target for the end of the year is 4.4%, and we're going in the other direction. That certainly raises questions about what the Fed's going to do in November. And if you look at the November Fed funds futures and OIS bets, everybody is rapidly cutting them down from the possibility of 50 basis points. We're now solidly at 25.
Solidly at 25, but it raises the question whether you need another 25 after 50. At the end of the day, when you looked at not just the hot jobs report, but the wages, I thought were really interesting too, coming in above expectations. Do you start having to worry a little about inflation again?
I think you have to worry about it a little bit in the sense that the Fed, which has emphasized employment over inflation at this point, and Jay Powell in his news conference said he didn't think that wage inflation was going to be a danger. I think they've got to put that back into the equation and say we're more focused on both sides of our mandate. It's a little bit of a surprise that we saw wages go up so much, because this was what they call a short month, fewer weeks between the pay periods. And so historically that would mean you would have a lower number, and we didn't get that. So at this point, the Fed's got to think about that at least. But we do get one more payrolls report before we get the Fed meeting. So that'll be much more dispositive, especially since now with the port strike settled, that one will be probably a lot more accurate, give us a reasonable picture of where the economy is.
Yeah, exactly. Those 3 days, maybe not distorting the data all too much. Bloomberg's Mike Mckee, we'll see you again in just about an hour's time. Of course, Mike will be speaking with Chicago Fed President Austan Goolsbee next hour at 10 a.m. Eastern. But before we get there, I am thrilled to say we're joined now by Blackrock Chief Investment Officer of Global Fixed Income. His name is Rick Rieder. Rick, it's great to speak with you, and we have a lot to talk about. As we were just unpacking with Mike, of course, an upside surprise on payrolls. It feels like a while since we've seen that. Of course, the unemployment rate dropping, and even revisions were upward as well. And with all of that in mind, how does that 50 basis point rate cut that we got last month look right now? Was that a mistake?
So I would say a couple of things. First of all, I agree with everything Mike Mckee said, except for the Yankee analogy. I'm an Oriole fan, so I'm in mourning. So, listen, these numbers are pretty staggering. Listen, I think when you cut into it and you think about, I think you got to go to this point of we're living in a service economy. This whole idea that hard landing's coming, it's just not even in the cards. Service economy. Look at the numbers on travel and leisure. I mean, look at healthcare, education, not interest rate sensitive. What does it mean for the Fed? Listen, I think what people more and more are picking up on is service level economy. It's not that interest rate sensitive. What does that mean for the Fed? By the way, you raised rates 500 basis points. You don't really have that much of an impact. We could debate what it did on inflation. Service economies don't go into have that sort of cyclical impulse, and you're seeing that play out. What does it mean for them today? Listen, I still think they could go I think they should go 25, and I think they will go 25, even though you've got a robust economy, because you have a two-stage economy now. A lot of the population is actually under some pressure, the ones that do borrow. It doesn't add up to a lot of aggregate growth in the economy, but it's a lot of people. And so if you got the funds rate down to closer to 4% in an economy, it's not that interest rate sensitive. It's not going to accelerate inflation higher. I think you can still get there, and I think the Fed should still go another couple of 25s. And then I still think they should go next year. And I don't think you're going to create any instigant for more inflation here. I just think the rate's still too high relative to where inflation is today.
Right, so a lot to dig into there. I do like the point that this economy, less interest rate sensitive than maybe some had been expecting. Hard landing not in the cards, but still the Fed should normalize policy here. Where does that leave fair value in the bond market? You take a look at the 10-year Treasury yield, for example. We are nearing 4% once again. We got as low as close to 3.6%. And of course, we were much closer to 5% just a few months ago. Where do you think fair value for benchmark rates are right now?
So, and I've said this before. First of all, I don't think anybody. I actually call this the golden age of fixed income. I actually think it is, and it's not because people are going to make a lot of money on interest rates. I think we are at fair value. We could debate is the 10-year. So the 10-year tends to follow nominal GDP. If you said today nominal GDP should run at a couple of percent, 2% real, 2% inflation, gosh, that gets you 4. Listen, I think if we're in this zone of 3.5 to 4, 4.25, you're pretty close to fair value. So I don't think it's going to cheapen a lot from 4%. I think the trade in fixed income, quite frankly, I think the trade in all assets today is actually build income. And what's going to give you today is you can get more of a chance to build income into portfolios. I just don't think we're going to make a lot of money on interest rates from here. I think we're going to be pretty stable, particularly out in the 10-year point or longer than that.
Fascinating, Rick. You are looking at a 10-year barreling towards that 4% level, now at 394, 10 basis points higher just today. What does this all mean at the end of the day for the direction of travel? Where is the neutral rate?
So listen, one thing that I think is pretty interesting, the market, I always get a kick out of people say the equity market's doing better because the Fed's cutting interest rates. Since the Fed moved 50, the front end, the very front end, the DEES 25, December 25, we've backed up almost 50, actually I think it's a bit more than 50 basis points we've backed up. Where are we now? I would argue, we moved to such aggressive levels because of this incredibly pervasive view of hard landings coming and unemployment rate is going up. I think you're pretty darn close now. In fact, I could see buying some pieces of the front end today with now you're at a level that if you say the funds rate, now we're pricing about 3.25. Where is terminal rate? I would argue not that far from there if you include some premium for risk. So gosh, you're getting to a place today in the front end where the front end has had no value, where now actually the front end is actually not bad again. Is it cheap? Definitely not. But it's not bad at these levels for the first time in a while. The front end was too rich. The belly of the curve was still attractive. Now you'd actually argue there's more value as well in the front end.
Rick, will you play this game with me for a while here? Because if you look at the change in payrolls, higher by 254,000, the highest estimate was 220. So how did everyone get it so wrong? And what does it say about how people recalibrate the path forward?
So, I'll say one thing about I'm still blown away that the assessment that when you get the ISM manufacturing report, everybody crowds around and like, oh my God, you see ISM manufacturing. I don't even know why it matters anymore. And you look at today's payroll report and you say, well, look at manufacturing, it's a little bit softer, but it's a small number. It's why, why I think what people misinterpret is we have a new economy. When you think about leisure and hospitality, get these numbers up 80-something thousand after a huge amount of hiring. Service economy, as long as Taylor Swift's still doing concerts, as long as sporting events are going on. I mean, we have a service economy, we have an entertainment economy, education, healthcare, pretty pervasive. And I think, I think why people misinterpret it, when you dig into the numbers, we could talk about manufacturing. Construction was up a little bit. Numbers aren't that big. Services. It's pretty wild how the world has changed. How the U.S. particularly, different in China, but particularly how the U.S. has changed is pretty remarkable.
And Rick, you're staying with us, but just to tie a bow on a point you made a couple minutes ago, that this is the time to build income, that you're not necessarily going to be making money on interest rates here. Are you saying that basically you're not going to be benefiting from a price appreciation in bonds, that basically it's about clipping coupons right now?
So if you say today, your point about the 10-year note of 4%, but then if you take the belly of the yield curve and if you decide where are we going to be the next year or two, my sense is that rates can moderately trend lower. I still think they're going to moderately trend lower. You obviously got a strong report today. Let's see what the data is the next few months. So what do? Let's just clip a bunch of yield. And so you think about, you can build a portfolio of fixed income. We run this ETF that called BINC.
I've heard of it.
We can build a portfolio of 6.25, 6.5 yield. So if you can just clip 6.5, let's say rates go up 30, 40 basis points, 50 basis points, not going to happen. But let's say that's right. You're clipping 50 basis points a month of yield, of income. So I think today, just keep building income, stay in income. Listen, equities will still do their job. I don't think equities are, the valuations of equities are full. I don't think they're going down because the economy's in decent shape. So I think equities are okay. My point being, boy, if you can keep clipping income in an uncertain world, that's going to work for you.
All right, Rick, don't go anywhere. We have to take a quick break. We also have to take a look at markets right now because there is a lot of action with less than 20 minutes until the bells ring. You can see the S&P 500 currently up about 0.8% pre-market, of course, close to session highs right now. Big tech is your leader, or not quite, mid-pack, because then you take a look at small caps. The Russell 2000 currently up about 1.7%. Now coming up next, more with BlackRock's Rick Rieder, and then later this hour, a conversation with Acting Labor Secretary Julie Su. This is Bloomberg.
And now for high interest, a look at what's making headlines around the world. Israel carrying out huge bombing raids on Hezbollah targets near Beirut airport, alongside some ground attacks in southern Lebanon. Israeli officials said the strikes targeted the potential successor of the militant group. Iran's supreme leader called on the Arab world to unite against Israel and said Tehran would strike again if necessary. And over in the EU had voted to impose tariffs of up to 45% on electric vehicles from China. The decision brings with it the potential for a trade war between the bloc and Beijing, as China vows to protect its companies and threatens levies on European dairy, brandy, pork, and automobiles. 10 member states backed the vote, while Germany and 4 others voted against it. There were 12 abstentions. And U.S. dock workers agreeing to end a 3-day strike that paralyzed trade on the U.S. East and Gulf coasts and threatened to become a factor in the presidential election. The International Longshoremen's Association and the U.S. Maritime Association have announced the decision to extend their previous contract through January 15th. Work will pick up again today, and the two sides will restart negotiations for a long-term agreement, which will include a pay increase of about 62%, Katie.
Yeah, and of course, we'll be speaking about that with Acting Labor Secretary Julie Su in just a bit. But let's take a quick check on futures because there's a lot to talk about. The S&P 500 up about 0.8% pre-market. The NASDAQ 100 Big Tech 1.3% on that index. Russell 2000, your small caps are the biggest winners today. And of course, that's against a backdrop of a bond market that is selling off quite mightily, Sonali.
Blackrock Chief Investment Officer of Global Fixed Income, Rick Rieder, still back with us here. And I want to go back to a couple things you were saying before. Kind of this strength of the U.S. economy, yes, it's promising, but also you have all of these overlays. You look at the union deal, for example, wages higher in the report this morning as well. When you looked at employment across the board, you also have Brent flirting with that $80 level. Rick, why aren't you more concerned about inflation?
So I'd say a couple of things. One, I think when people go back and think of where has inflation been and what spiked inflation to these excessive levels, it was largely supply chain shock. It was logistics shock. You had a one-time 100-year pandemic that drove us to excessive levels. If you said to me today, we're going to run inflation 2.5. By the way, we don't think inflation. It's been decelerating. If you take the 3-month moving average, 6-month moving average, it's been decelerating pretty quickly. But if you said to me, we're going to stay at 2.5 for the next year or so, I wouldn't debate that at all. I think most of the inflation improvement has already happened. And, our projections, James Sweeney, our economist, our projections show that we're going to stay at 2 or a little above 2 for a while. Could you pick up a little bit? It's possible. The point being, though, this is not scary level of inflation. And by the way, we've got a huge debt problem in the country. And so you want nominal GDP inclusive of inflation. You don't want it to drop that much. You'd actually, if you're in this 2.5, it's not scary. It's not devastating the economy in any way, shape, or form. So, but it's not excessive inflation, and I don't think there's any chance we're going back there.
Well, Rick, let's bring this conversation to the corporate credit market and use Bank, of course, your ETF as a jumping off point. You have an average rating of BBB+. You were saying before the break, of course, that when it comes to duration, where you want to be on the curve, there could be some opportunities arising in the front end. But when you think about the credit market, are you willing to take a little bit more credit risk here, or what's your thinking there?
Part of why I'm so excited about fixed income today, and, quite frankly, we've lived in 3 years where equities have done extremely well. They're still doing extremely well because you've got a strong economy and you've got a technology boom in infrastructure, AI infrastructure, et cetera, that's pretty extraordinary. Credit today, when you have that strong an economy and you've got yields up here because the Fed is keeping the funds rate high, you're actually able to finance companies at levels on a real rate basis relative to a 2% inflation that are extremely attractive. Are the spreads attractive? Not really. But as long as I'm clipping that sort of yield, and if you took where we're lending companies money on a default adjusted basis, it's actually pretty darn attractive. And so we could debate what is the risk-free rate. Is a Treasury the risk-free rate? We're going to issue an awful lot of Treasuries the next couple of years. It's actually not that. Certainly there's not that much high yield supply. There's not that much high yield supply in Europe. So I like lending. And one of the things I think is incredible, in my career, you've always had to how do I get yield? How do I get yield? I got to buy some exotic EM to get some yield in the portfolio. Today, you can own AAA CLOs, you can own agency mortgages, you can diversify a portfolio and own credit and clip some really good yield. And that doesn't happen. We've had a couple of decades of very low interest rates.
Right.
That's pretty neat in an economy that is operating well.
Yeah, you don't have to reach too far for yield right now. Plenty of higher quality options here. I'm curious, though, you're pretty upbeat about the economy overall. But of course, if rates stay higher, if the Fed doesn't have to cut as quickly as maybe some people had thought, maybe before this report, what does that mean for the riskiest credits out there? The CCC territory where maybe you don't play as much.
Totally right. It's not great. That's a balance. As long as you're clipping enough cash flow and the growth momentum of the economy keeps you afloat, you're in pretty good shape. But you're definitely right. One of the things that's interesting about credit today is there's part of the credit market that is, you've seen interest coverage numbers that have come down significantly. So do I need to, it gets to the point of, how much do I want to play? There's some restructurings we get involved. There's some interesting things that are idiosyncratic. But gosh, I'd rather stay in high yield, single B in the U.S., in and around single B, double B in Europe, And, and then we'll make an idiosyncratic decision on some individual triple Cs. But you're very right in pointing both in the leveraged loan market and in the high yield market. There's part of the market that's got some stress, and rates staying higher certainly doesn't allay that.
It's interesting. I'm glad you brought this up. I'm glad Katie's been focusing on it too, because I think you look at where spreads are and it shows a lot of complacency. For the people who are playing around with credit risk, what's the cautionary tale here? How much stress might arise, especially as we probably are not going to see as many rate cuts as expected unless you see the economy turn much more meaningfully?
So, I've had my fair share of going through some volatility and cycles in different markets and stress. If you lay out, by the way, usually what created stress in the past doesn't create it in the future, and it's always hard for regulators to try and manage that because it's usually a different instigant that creates it. If you said to me, what is the risk going forward? You don't have, we think about high yield, you had energy risk, you have industry risk. What is certainly today, if you think about the go forward, geopolitical's the big one. Do you have some policy issue? What I think is the issue for the next 12 to 18 months, although I don't think it's a problem over the next year or so, is I think the debt problem in the country. When you start thinking about what do we do in the risk-free rate and the currency, if policymakers don't address the debt, the deficits, the debt service costs in the country, that to me is the big ogre that's sitting out there. But it's not today, particularly with a Fed that's generally cutting rates or is cutting rates, and you have people that haven't been investing, they've been sitting in cash. That will be okay for a bit of time, but that's the one that is in the back of my mind. You got to keep your eye on. It's part of why, do we need to own the long end of the yield curve?
Right.
Not really. Let's clip a lot of yield shorter to the belly of the yield curve.
All right, Rick, we have to leave it there. Always a pleasure to speak to you. Of course, that is Blackrock's Rick Rieder. Have a great weekend. Now, coming up, Harley-Davidson dealers not feeling revved up, according to one analyst. That's in our Social Climbers up next. This is Bloomberg. All right, we are just moments away from the start of trading on what's shaping up to be a very good Friday, at least in the markets. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld, and you can see the stocks behind me doing great right now. Of course, we got those NFP numbers at 8:30 a.m., adding more than expected on payrolls. The unemployment rate actually came down, and we haven't seen this in a while, but upward revisions to prior jobs number. Wall Street is celebrating right now, of course, and you can see that enthusiasm with the clapping going on behind me at both the NASDAQ and the New York Stock Exchange. Of course, October had been a pretty soggy start, but maybe the narrative is going to change today. Let's take a look, of course, at the major indexes, how they're faring just seconds into the trading session. You can see the S&P 500 currently up about 0.8%. We're going to be talking about all-time highs again. You take a look at the NASDAQ 100, big tech leading the charge here, 1.2% higher on big tech, but don't count out the small caps. The Russell 2000 currently up about 1.5%. Of course, those smaller companies really celebrating the strength that we're seeing in the labor market. Let's take a look under the hood, though, because there's one bad news story, and that's Spirit today. It's plunging as months of talks with bondholders failed to result in a deal. That is according to sources. The airline, of course, trying to restructure its debt and avoid filing for bankruptcy. You can see shares currently off by almost 35%, Sonali.
Some more of the good news stories over here, too, Katie. We're watching Summit Therapeutics surging after it said that the FDA will fast track its lung cancer drug for use in chemotherapy. You have Summit now up more than 8% as the market opens. But another bad news story to look at, Rivian has cut its production guidance for the full year due to supply shortages. Rivian shares at the open down more than 4%. Let's take a closer look at Rivian with Bloomberg's Ed Ludlow. Talk us through it, Ed.
The drop at the open is not as bad as it was in the pre-market. At some point in the third quarter, there was a significant supplier issue that got worse. We don't know what that is. We don't know if it relates to a specific part. We just know that it relates to the Enduro electric motor or drive unit that Rivian manufactures in-house. And it's a really kind of change in the picture for this EV name, because if you think about it, the production guidance of 47,000 to 49,000 would actually represent a drop of 18% from what they managed to build last year. This was a company that was kind of on the up a little bit. They're expecting to build prior to this morning 57,000 units this year, and they continue to demonstrate teething problems that they can't get past.
And of course, marry this together with what we learned from Tesla earlier in the week, of course, missing its target when it comes to third quarter deliveries. You actually have Tesla shares up a little bit right now, but actually down 5% for the week. How do these two stories wrap together?
Oh, well, in Rivian's case, I think it's not an industry problem. I think with Rivian, it's a Rivian problem. They're not being that open or transparent or detailed on what's actually going on with this specific part or where the issue is stemming from. You know, Tesla were not prescriptive on their miss. I go back to the granular detail that we discussed on this program, which is that 3 and Y, which are the volume models that Tesla makes, came in above sell-side expectations. That other bucket, which includes Cybertruck X and X and S, came in below expectations. Both names, Rivian, which is a niche, lower volume player, but Tesla specifically, have suffered in a higher rate environment because it's put a premium on electric vehicles. Tesla has had the lever of heavily incentivizing consumers that Rivian doesn't have the luxury of doing. It burns too much cash, can't do it. So it will be interesting to see if there is a big picture industry theme here, but I think Rivian's problems are their own.
All right, Ed Ludlow walking us through the nuances going over in EV land. Really appreciate your time. You can catch Ed on BTech, but stay right here because we're going to broaden out this conversation right now with BNP Paribas U.S. Head of Equity and Derivative Strategy, Greg Boutle. Greg, great to see you again.
Good morning, thank you.
Okay, so green on the screen, of course, the labor market holding in there, the Fed cutting into strength. Seems like life is pretty good right now.
Yeah, I think if we're going to get a Fed cutting cycle and it's going to be accompanied by strong data, the likes of which we've seen this morning, then I think it's a recovery story for some of the cyclicals. So you see in the index space, it's the small and mid caps leading today. That's consistent with the data.
Well, it's interesting. Even if you have the expectations for rate cuts declining here, that movement that we've been watching in the Russell 2000, it's not what you've been seeing at other moments where we have seen that similar concern. Does one day start a new trend, or is this something to be wary of?
No, not at all. So I think we have to be nimble and mindful of the fact that we've had a very rocky ride over the last 3 months, where we had, the Russell rally massively back in June off a weak CPI print. And then we saw some precipitous declines when the labor market data and the ISM were weaker. And now we get a better message today. So I think the message from us is that there's a wide distribution of returns and vol ahead.
Well, let's get philosophical here. Let's step a little bit back and talk to us about the psychology of this market. Is this a tactical sort of opportunistic market, or is this sort of a stick to your guns, long-term, follow your narrative market?
I think depending on which parts of the market you're looking at, there might be different stories where you have to be nimble, but then there might be some of those themes which do run much further. So at the moment, we've got a lot of uncertainty. We've had some pretty massive moves come out of China. We have the US election still to come. Q3 earnings really gets into full swing next week. And obviously the macro data has been at a bit of an inflection point where people are trying to work out, is this slowing too fast, or is this actually a benign soft landing with a cutting cycle?
Well, let's get specific here. I mean, where do you see the opportunity and the need to be nimble when you take a look at certain parts of the market? And where is the story roughly the same, would you say?
So I think where we can be nimble is looking at where there are different messages from different parts of the market. So one of the things that we highlighted 10 days or so ago was that we'd seen almost every cyclical sector rally in Q3, apart from the oils. So we think we can find where there are some unloved parts of the market and a potential for convergence, really. It's hard to see things like the banks, the home builders up between 15 and 20%, and a sector like the oils just remain in the doldrums.
So how do you play the market from here? Because up till now, the S&P equal weight has been a place that many investors have been looking for that rotation trade. So what do you like better? The SPW, the S&P equal weight, the S&P 500, the NASDAQ 100. You're seeing just a tear in tech stocks after all of this movement. What do you like?
So I think that there is probably the most opportunity, the fattest right tail within the small and mid caps, but there's also probably some of the largest risk there. So I think that is the index that has been most macro sensitive.
The Russell.
Yep, it's been most macro sensitive, and it's been most sensitive historically to the elections. So we think there's potentially the most upside there, but also some of the most risk. So we've been talking about using optionality as a way to kind of navigate that risk-reward profile.
You know, until this point this week, of course, this is tremendous optimism this morning off the heels of this jobs report, but it's been a really rough week. A ton of geopolitical conflict. It's been a choppy trade. Oil prices rising once again. The VIX rising back to 20. It's not been as high as we've seen this year, but there's clearly some fear under the surface.
Yep.
Where do you hedge?
So I think the interesting thing about the VIX, just touch on that for a moment, is where we are relative to the broader equity market. Because the VIX has spiked during equity market sell-offs, but finding ourselves close to all-time highs in 20 at the VIX is very anomalous, particularly when you look at how much the S&P has moved recently, which is not an awful lot. So I think in terms of optionality, we've been talking about trying to use options to express directional views. So the VIX is a more pure volatility play. Do I think the VIX is necessarily going higher? Maybe not, but I think there is value in using optionality to play directional trades. So one example of that is if we go back to the 2016 election, we saw some huge moves in things like the Russell, much more than was implied by the options market. But that wasn't necessarily a story of higher close-to-close volatility. It was more that there was a big trend and a fat right tail.
Well, let's build on that a little bit. Using options to express your directionality. Some people might say that seems like an expensive way to just go long, just versus just actually buying the index. I mean, what benefit do you get by tapping the options market to express your views right now?
So I think if you have absolute conviction and you want to be purely long delta, then you're probably right. You're paying a premium for that added optionality that you get from using the volatility market. But when we look ahead to whether it's earnings season or the US election, if you don't have conviction of who's going to be in the White House, whether it's divided government or a sweep, then you could say that there is some value, we certainly see it, in embedding optionality into those trades.
But are the days, to Katie's point, of setting and forgetting an S&P 500 ETF a little bit over at this juncture, given what we're seeing?
That would be a huge call.
Yeah, well, I think that if you're able to be nimble and navigate some of the rotation that we've seen, there's alpha to be extracted there. I think if you're able to navigate the options market, there's extra returns that can be navigated there. It doesn't mean that you can't make expressions through broad-based ETFs, but I absolutely think the last 3 months is evidence that there's opportunities to rotate under the surface.
Greg, stay with us. Of course, that is Greg Boutle. We're also going to take a look at some things moving under the surface because there is a lot of movement broader than the equity market indices. We're looking at American, Frontier, and JetBlue shares surging more than 10%. That's all as Spirit Airlines is sinking. Remember, Spirit has had months of talks with bondholders failing to result in a deal, according to sources. The airline is trying to restructure its debt and avoid filing for bankruptcy. Just incredible movement here. American now up almost 9%. Frontier just surging more than or nearly 20%. JetBlue up 13%, but Spirit still down by more than 34%. Now coming up, Morgan Stanley getting an upgrade as big banks get ready to report results later this month. Starting next Friday, those numbers come out. We will be all over it, but stick with us. More ahead. This is Bloomberg. This is Bloomberg Open Interest, and you're looking live at the Principal Room. Coming up, an interview with Chicago Fed President Austan Goolsbee. That's the next hour at 10 a.m. Eastern. This is Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a check on stocks right now because we are ripping. If you move up the size tiers here, the S&P 500 currently up about 0.8%. Big tech up about 1.2%. That seems pretty good, but then you take a look at the small caps. Your Russell 2000 currently up about 1.5%. Of course, there's a lot of daylight between now and 4 p.m., but for right now, looks pretty good. Meanwhile, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, HSBC upgrading Morgan Stanley to a buy, saying that the bank's period of underperformance against Goldman Sachs and the broader market might be ending. Next up, Bank of America cutting Warner Music to a sell. The firm cites a stretched valuation and highlights disappointment in the company's emerging platforms. And finally, we have Truist Securities saying that Dine Brands, that is the parent company of Applebee's and IHOP, it's no longer a buy. The firm is downgrading the stock to a hold after concerns about slowing sales trends. Currently down about 4%, Sonali.
And we're back here, Katie, with BNP Paribas U.S. Head of Equity and Derivative Strategy, Greg Boutle. And, big sigh of relief in the market. You see it in the price movement after that jobs report. Of course, employment holding strong. Now it's time to turn the page. Let's look to the next set of catalysts. What is a bigger deal ahead? We have an election before that next Fed meeting. Is there anything else in between that could shift the narrative around equities?
Yes, I think earnings season is the biggest catalyst that we see on the radar. So we've had a couple of off-cycle reporters report recently, FedEx, Nike, not necessarily glowing reports. We move into next week, and next Friday it really gets into full swing with the banks. So I think that Q3 has historically been one of the most important reporting seasons, producing some of the largest returns for equities, because you tend to get a bit more of a glimpse into guidance and what 2025 might hold.
Let's talk a little bit more about the upcoming election. Of course, we want to get into earnings as well, but when it comes to the election and how you prepare your portfolio for it, speaking to you with, of course, your equity derivatives hat on, there was an interesting story on the terminal a couple days ago about how basically people are waiting to hedge the election in the options market. Is that the right route to take here, or is it time to start?
Well, for us, it's more level opportunistic. So if you go back to the 2016 election, what you saw was some pretty wild price action in the options market. If you look at the VIX or the VIX futures or VIX options, it was very benign in the run up to the 2016 election until you got 2 weeks out, and then some of that hedging activity exploded. So for us, it's more about picking the right levels. That's why our thesis is buy the dips and optionality. Be price sensitive, but try and find those opportunities to hedge. Don't just wait mechanically until the last week or two.
So statistics was one of the favorite things that I liked as a total weirdo, as you know, Katie. There's an interesting chart in that note that Katie's talking about with the distribution of outcomes. And I think that's really important here. And it seems like you and many others believe that the left tail event here is a blue wave, but more likely, still not too likely, is a red wave. Yep. What would either of those mean for the market?
So I think when we think about what elections mean for kind of economics and society at large, you can talk about a whole range of things. But when we talk about equity markets, it can be quite simplistic. Do you think you get forecast upgrades or downgrades off the back of this? So corporate tax rates is the biggest, most obvious thing. We saw it back in 2016, Tax Cuts and Jobs Act. You got corporate tax cuts, you got massive earnings upgrades, and the market went up. So simplistically, if you think in a red wave, you get tax cuts, it's going to be more market. It's going to be more market kind of positive, constructive. If you think a blue wave involves tax hikes, then it's probably going to weigh on the equity markets, which is why a divided government one way or the other probably has far less beta impact for the indices.
All right, so keep an eye on the down ballot races. Before we let you go, we've spoken a bit about fat tails, of course, and I'm curious, when you look at all the possible events out there, all the possible risk factors from the economy, the Fed, the election, what's going on overseas, those hot wars developing right now, where is the biggest potential for a black swan?
The black swan is often the thing you don't see coming. I think when we look at the kind of known unknowns, if you like, it's the idea of having a kind of a continuation of events. So if you were to see the labor market really crack, we had the SAM rule triggered recently, you were to have a blue wave, that's how you get to the fat left tail. I think for the fat right tail, it's this idea of the Fed cutting, the labor market being pretty strong, and then potentially getting a Republican sweep and tax cuts. And I think it's small and mid caps to come back to that part of the market we were talking about at the top of this, which is most sensitive to all of those factors.
All right, tying it together really nicely. Greg, it's always great to see you. Have a great weekend when you get there. That is Greg Boutle from BNP Paribas. Now coming up, Acting Labor Secretary Julie Su joins the show. This is Bloomberg. Welcome back to Bloomberg Open Interest. The U.S. added 254,000 jobs last month. That was beyond all estimates to the upside. Let's unpack it now with Acting Labor Secretary Julie Su. Secretary, it's great to have you with us. Of course, we have a lot of good news to talk about, from the upside surprise on payrolls, of course, the unemployment rate dropping, and of course, that port strike suspension. Let's start with the labor market, though, because as I mentioned, of course, beyond all estimates to the upside, and then you take a look at some of the details on the demographic level, even more good news when it comes to white, black, and Hispanic unemployment. Where do you see the greatest source of strength? What were some of the factors driving those improvements?
I think this has been the story of the economy under the Biden-Harris administration, frankly. Many people predicted that we would not be able to do this, have this kind of recovery, and have incredible job growth while keeping the unemployment rate low, while bringing down inflation and interest rates. All of those things are now happening. We saw growth in this last month in healthcare. We saw it in restaurants. We saw it in local government. All of these things translate into quality of life, right? It's not just workers out there doing jobs. It's potholes are being fixed. It's increased public safety. It's people getting back to normal, right? Remember, 4 years ago this time, a lot of restaurants were closed. Mm-hmm. Now it's the industry with incredible growth in the September report. It was back to school 4 years ago, back to Zoom, because we were in the middle of a global pandemic and there was no national strategy to get it under control.
Right.
4 years ago, kids were being told no trick-or-treating for Halloween. We are in a very different place right now, and that is in no small part because of strong leadership and economic policies that have helped to fuel an unprecedented economic recovery.
And Secretary, as you know well, a very strong report overall. If you were looking for some weakness, you would find it in the manufacturing sector, of course, shedding another 7,000 jobs. That was slightly better than estimate, but a contraction there nonetheless. And the downward revisions there were actually lower. So what is the administration doing to address what's going on in the manufacturing sector?
So here's the story of manufacturing. President Biden and Vice President Harris have been saying since day one, we believe we can make things in America again. We can open up factories that were shuttered in the last administration. I visited some of those, factories where people had to leave their community, leave their families to go find jobs elsewhere that are being opened up again. But it also takes some time to reverse the really decades of disinvestment in our manufacturing industries. Now we're making historic investments now, and that's really showing up in the construction sector. And you got to build the manufacturing facilities before you can hire people into them. And so this is, even this jobs report, as great as it is not a declaration of victory. It's a declaration of progress. We are making significant progress, and we need to keep up that trend. We need to keep up that work. Manufacturing jobs have grown, but they're going to grow more as we keep investing in America.
Well, let's talk, of course, about the other piece of good news this morning, and that is that the 3-day strike at East Coast and Gulf Coast ports has ended. The contract extended through January 15th. I know that you were heavily involved in the negotiations. The New York Times reporting that you were in New Jersey yesterday, of course, meeting with the unions. Talk to us about how it happened in the end. What did you do? What did Secretary Buttigieg do? And what did Joe Biden do?
Look, this is another example of many in this administration of just how powerful and effective collective bargaining is. When workers have a voice at the table, when they have a union on the job, when they can come to the table, sit down with their employers and talk about what's good for them, what's good for their company. It's better for the economy. It's better for the nation. We've seen that from auto workers to airline flight attendants, from hospitality to healthcare, and now at the docks as well. And this was a situation where longshoremen who do difficult and often dangerous jobs worked through the pandemic, strapped the country on their backs, and have helped to fuel record profits. Shipping carriers have made tens of billions of dollars in profits over the last few years. Again, that's partly because the economy as a whole is strong.
Right.
So when the economy is strong, everybody benefits. And this is an example of how when workers have a voice, when collective bargaining happens, workers can get their fair share. And at the end of the day, when I was in New Jersey, when this was about to happen, the longshoremen were saying, let's get back to work right away. They were ready to go back last night. That's because working people understand how important they are. They understand their contributions, and they are showing up every day to make them. And we are really happy to see them getting their fair share.
Well, Secretary, it's a victory, but it's a partial victory because we're talking about an extension until January 15th. So what is still yet to be resolved here between now and January 15th?
Yeah, it's such an important point, right? Collective bargaining is a process. And you heard the president say this. I'm grateful to be in a cabinet of other people who are fully committed to the idea that we have to trust the parties. And now that they're coming back to the table, they're going to deal with all of the other issues that are on the table. And I have great faith that they're going to get to a fair contract and be able to move forward together to the important work of our supply chains and helping to continue to make sure we're the strongest economy in the world.
So you have great faith here, but I mean, is it possible that we're going to see this fall through in January, that we're going to see a return to the picket lines when you think about some of those issues that are still yet to be resolved?
Well, the vast majority of contracts, when they're being negotiated, end in a contract. I've been all across the country, both celebrating those outcomes and urging the parties to stay at the table. So the ones that we hear about are ones that become, more contentious. Now, a lot of times that is because workers for a long time have been falling behind. There have been, the economy in the last administration was not as strong as it is now. The contract for these longshoremen was negotiated in the last administration. Today, the economy, as demonstrated by the jobs report, is stronger. It's different. And so we believe, now the parties have resolved one of their big issues. The best way to get this done is for them to sit down together, and that's exactly what they're going to do.
All right, we really appreciate your time. As always, of course, know it's a busy morning for you. That is Acting Labor Secretary Julie Su. Meanwhile, let's take a look at the impact that jobs report is having in the market, because it's fueled a rally, but it's coming back a little bit. You take a look at the S&P 500. It's still higher, but only by about 0.4%. We were higher by about 1% earlier. Then you take a look at big tech, of course, also pairing gains here, still up about 0.6%, but of course we've been looking gains of about 1.5%. The bond market, meanwhile, holding its sell-off. You can see yields still up to the tune of about 9 basis points on the 10-year yield. Sonali.
I also want to bring you some breaking news. From the Bloomberg Deals team, you have Tencent and the Guillemot family are said to await a buyout of Ubisoft. Of course, you have Ubisoft shares, ADRs in the United States soaring more than 21%. And remember, video games have been a massive point of focus here for the deal industry. And of course, just another mega deal that may be weighed, Katie.
All right, we're going to continue to keep a focus on that. But let's turn back to the economy. Of course, that is the story of the morning. And who better to talk about it with than Mckee? He is Bloomberg's chief international economics and policy correspondent. So we just heard from Julie Su. Of course, you have a great conversation with Austan Goolsbee coming up. But you think about the details of what has been agreed to when it comes to the port's 62% wage increase there. What does that mean for inflation?
Well, it's a good question, and we do have maybe inflation coming back is a little more emphasis with the Fed. But generally, when you have a contract like this, what it means is you get a raise once a year, say January, which is when most people's come in. That'll get seasonally adjusted, so you have a one-time rise in the inflation rate, perhaps, but then it doesn't keep going over the year. So while this is a significant contract increase for the workers, on a year-over-year basis, it won't have a major impact. Each year you'll ratchet up a little more than you otherwise would, but it's also somewhere around 80,000 workers who get covered under this contract, and we have 155 million people working in the country, so it probably won't have as much of an inflation impact as it could have if there were more unions that followed this as a pattern bargain.
I'm going to be the wet blanket and think past November a little bit here, because of course you have another Fed meeting, of course those 50 basis point rate cut bets getting wiped out of the market at the moment, but you still have 160 basis points worth of rate cuts through the end of next year. At the end of the day, how muddy might the picture be in employment, just even through the end of this year, given what we've seen with the hurricane, given contract negotiations not just at the ports?
Well, not quite as muddy as it would have been if the port strike continued. We have Boeing still out on strike. If that's not settled by the time, by next week, I guess, is when we go into the survey week, then we'll have to subtract 38,000 or, from whatever the total is. And then we don't know yet what the hurricane impact is going to be, but we know it's going to be larger than usual. And so the BLS will put a note in their report for October, their best estimate of what the impact is. So we can subtract that out. We'll see how much of an impact it has. And the Fed will look through both of those things because they know that they're temporary. And what ends up happening with natural disasters is you end up with more spending because of the rebuilding, and probably there will be a lot of jobs that are lost but then recreated after this over a period of time.
That's a really interesting point. So in a way, I mean, there is an economic benefit here to that rebuilding effort.
Yeah, it's always tough to be an economist and say that, because obviously this is a major tragedy for the people who were involved. It's a horrible, horrible thing. But history shows that because of the money that's spent to rebuild, you end up with a little bit of a boost to GDP.
A boost to GDP, but of course, a messier economic report when it comes to next month's jobs report, it sounds like.
A little bit messier, but less so now that the port strike is settled. It comes 4 days before the election. If you have a report like this, I know one campaign that would be very happy if they got this November 1st.
You know, there's also inflation next week, if anyone's paying attention.
I think they are. I would imagine that they are paying attention to inflation. And of course, next month's jobs report, which is the final jobs report before the election, which of course the Federal Reserve will be paying close attention to. And I know that coming up, you have a great conversation right now.
Yes, we're going to turn our attention now to the Federal Reserve and Chicago Fed President Austan Goolsbee, who joins us now to talk about the numbers that we've just gotten and what it may mean for him and what it may mean for the Fed. Good morning, Austan. Thank you for being with us. And you know,
Mike, good morning to you.
You know where I got to go first. You're the one that said we need to cut significantly in the future in order to keep the unemployment rate from rising. Do you still feel that way after the unemployment rate fell, and if it was rounded down by 0.02 of a percentage point, it would have been 4%?
Yeah, look, my statement was about over the next year and what's the long arc. This jobs number today and the whole report is a superb report. You really couldn't ask realistically for a better report for the economy, coupled with the finding out that the port strike is not going to be an extended matter, and that at least for months this is not going to be an issue. Those are two pieces of very good news for the economy. I still think, as a central bank, you don't want to react too much to 1 month's report, but the revisions of the previous month's upward in jobs growth and the unemployment rate coming down, if we get more reports like this, I'm going to feel a lot more confident that we are, in fact, settling in at full employment.
I know this has only been out now for a little more than an hour. Has your staff or you looked into it enough to try to figure out why the report was so good?
Well, I mean, you're getting a lot of the estimates of GDP growth still continuing to suggest that growth remains robust. So I think the first thing about job growth is that it's tied to how the economy is doing. So if you get strong reports, that's likely to be correlated with strong GDP growth. As I say, we've got some cross currents, and we need to take the longer arc. We had previous to this one 2 disappointing numbers. Now we have a superb number, and we need to keep monitoring it. If we get more reports like this, as I say, I think we should have more confidence that we are, in fact, settling in at the landing spot that we want from a dual mandate perspective. Inflation has been coming in right around 2%. If the unemployment rate is going to settle down something just over 4%, you would love to freeze frame that and put the picture on the wall.
Does this perhaps change the emphasis a little bit for the Open Market Committee? Jay Powell saying at his last news conference that the risks to inflation and to employment are about balanced, but we're more worried about employment. Do you have to add more weight on the inflation side now?
I don't know. I agreed absolutely with what Chair Powell said at the press conference, that we went through a period where getting inflation down from its extreme highs was the order of the day. That was really almost the sole focus. And now, when we had 2 disappointing jobs numbers, it made clear we're in a balanced environment with balanced risks. That we got a superb number, I'm extremely happy with. But let's not lose sight of what's the longer thread. Over the next year, if you look at the SEPs and the dot plot, a large majority of the committee feels that conditions are going to improve on inflation, that we're going to keep getting closer to 2% target, that the unemployment rate is going to stabilize at full employment, and that rates are going to come down a lot over the next year, 12 to 18 months. And that seems quite appropriate. If you are in a good spot on the dual mandate, that inflation and unemployment are where you want them, you just got to be careful keeping the rates as restrictive as they are, so far above where committee members think they need to settle. If you're not careful about that, you will lose the freeze frame that you want on either inflation or on employment. And if you look at expectations, there are some signs that inflation might undershoot the 2% target, and we want to be mindful of that too.
Well, let me ask you, if you're looking at inflation that might undershoot the target, are you think you're too restrictive, but yet we're seeing growth of 3.1%, according to the nowcasters, and we're seeing a 254,000 jobs print. Are we really that restrictive?
Well, you have cross currents. That's what I'm trying to emphasize. There are pieces of strong data, and then there are pieces of weakness. And if you just look at the dot plots, where does the committee feel that it will be appropriate for rates to settle? It's a long way below where it is now, if you think of that as what the R-star or neutral rates would be. So that is the sense in which, over a long period, we need to get what's the through line, and we need to try to maintain conditions very much like what they are now. So if we get more reports where GDP is strong and the unemployment rate is staying in the 4.1 range or even going down, then we're going to have a lot more confidence that we're hitting the target that we want.
Well, do you think the neutral rate is higher now? Where would you put it, given the strength of the economy that we see?
It's hard to say exactly what it is. I think it is definitely higher in my mind than the zero where we were for a lot of years before COVID. If you just kind of look at those dot plots, the settling down range, the bulk of it looks to be kind of in the 2.5 to 3.5 sort of range. We're still a ways off from having to sort that out, I guess I would say. If you're at 5 and people think you're going to end up between 2.5 and 3.5, you have both time and runway to figure out where the settling point is.
Well, the narrative coming into today was that companies weren't firing people, but they weren't hiring people either. And obviously that was not correct in the last month. What are you hearing from companies in your district about their employment plans?
A lot of we have 30, 35 different business roundtables throughout the year where we go and contact executives, community leaders, community development, financial institutions, and we ask, what is the experience on the ground? And we have a lot of business contacts. Mostly what I have heard has been of the more of the same, steady, not going down, but not really accelerating. So it'll be interesting to see as we come through to the end of the year here, if the GDP nowcasts are correct, that growth is going to be higher than trend, let's call it, higher than expected. Will we start to see that in the reflected in the comments for the Beige Book and others? The one thing is we're more intensive in manufacturing here in the Midwest, and there is, as you know, a bit of a shift back of consumer spending towards services and away from physical goods as we fully come out of the pandemic. So that weighs down economic activity a little bit in the manufacturing sectors. But you've mostly been hearing steady as she goes, not reacceleration and not a real drop-off.
Well, then, if it were up to you, I know you're not a voter this year, you will be next year, does this report change the idea of how much the Fed might want to cut in November? And is it possible we get another report that's good, even if it's not this good, that you just stay on hold?
You know, I don't like pre-committing before we've had the discussions at the meetings for what the rate should be. Over the longer run, which is what a central bank, the hardest thing the central bank has to do is get the timing exactly right when there are moments of transition. So this isn't an easy process. There's definitely an art to it. If we get more reports like this, and I'm going to have more confidence that we are settling in at a full employment, low inflation kind of a baseline. If you take the broad job market, I don't want us to overreact to 1 month's report. We've seen, if you take vacancies to unemployment ratios, if you take the hiring rate, the quit rate, a series of labor market indicators, they suggest the job market has been cooling, but the level is quite favorable. And if we can settle in at this level and things not get worse, well, that would be a very, very comfortable outcome.
Well, right now we're looking at, as you mentioned, somewhere between 150, 200 basis points of additional reduction in the Fed funds rate by the end of next year. Do you think that if we settle in, as you say, that would be significantly less?
If we have improving jobs numbers and GDP growth of 3% from now till whatever, I think the first thing we'd start doing is say, is the rapid productivity growth that we've observed for the last year and a half, are we in a new period like what we saw in the mid-90s? And if so, we're going to have to recalibrate what is expected potential growth. Well, if we get, yeah,
go ahead.
You want more on that?
Well,
I was going to say what the ultimate R-star neutral rate that we're going to settle down at depends a lot on what you think that potential growth rate is. So if productivity growth keeps booming like this, that does imply a faster growth rate. I think that does imply, just in the economics, that there would be a higher R-star. But in a way, that would be the glorious version. It's only because the economy can handle it.
All right, let me ask you one last question here. Did we hit a soft landing?
Well, you know, the problem with the analogy of the soft landing is that it connotes stopping. The economy never stops, so there's never a mission accomplished. We hit what I called the golden path already in 2023, which was we got inflation down substantially, almost as much as it has ever fallen in a single year without having a recession. That's basically never been done before. If now what we're going to be able to do, if we could keep unemployment in this between 4 and 4.5% with inflation hovering around the 2% target, that's exactly what the intention has been all along for the Fed, and everybody should be happy if we can pull that off.
All right. Our thanks to Austan Goolsbee. He's the president of the Federal Reserve Bank of Chicago. We'll see on November 7th what the Fed does next. Next employment report is November 1st. This is Bloomberg.
Thanks.
This jobs report, as great as it is not a declaration of victory, it's a declaration of progress. We're making significant progress, and we need to keep up that trend. We need to keep up that work. Manufacturing jobs have grown, but they're going to grow more as we keep investing in America.
That was Acting Labor Secretary Julie Su joining us earlier in the show. And of course, after that hot jobs report, there has been this chorus kind of building under the surface of whether 50 was even too much. And billionaire Stanley Druckenmiller, of course, is an investor that has certainly held that concern. He tells me now that he's actually concerned the Fed has boxed itself into a corner when it comes to future rate cuts. He said that he hopes the Fed is not trapped by forward guidance the way they were in 2021, GDP above trend, corporate profits strong, equities at all-time highs, credit very tight, gold new highs. Where's the restriction? Where's the restriction, Katie?
I have an answer for him. Of course, I'm really glad that you got those comments from him because he's speaking as an investor, and that makes sense. And he's completely right that you take a look at financial conditions. They're pretty easy, especially relative to history. But you asked, where's the restriction? It's in the housing markets. It's in auto loans. You think about the consumer right now. The consumer would certainly tell you that things feel pretty tight right now.
You know, it's incredible. I saw a note over from Connor Sen at Bloomberg Opinion saying you need mortgage rates, and this is very unlikely, to drop below 3%.
Oh, can you imagine?
Can you imagine to unlock that housing market? We are a far ways off. We're going to get some more insight into that jobs report. Of course, stunning Wall Street this morning. We are joined now by Tiffany Wilding. She is Pimco's economist here. And you looked at the data this morning. We were talking about how not only was the market off, they were off by tens of thousands. The highest estimate at 220,000 was more than 30,000 off of where we actually fell. How does this start to change the equation?
Yeah, I mean, this labor market report this morning was just undoubtedly strong. You know, as you mentioned, much stronger than anyone on the Bloomberg consensus panel was suggesting. You know, and I think that it just overall, it just confirms that some of the weakness that we saw in the labor market reports over the summer was, was maybe more noise, and that overall things are going okay. You know, now we still think the economy is slowing. We've been saying slowing but not crashing, and I think certainly the markets and the Fed were very focused on potential downside risks as a result of the weaker labor market reports, and I think that this just kind of confirms that things are okay in the U.S. economy, and so those kind of recession risks that should moderate somewhat as a result of this.
Well, let's talk about what this means for the Federal Reserve. Of course, you've seen bond traders basically rip up the script and say, okay, another 50 basis point cut. It's not happening, at least not in November. And we just had a great interview, Mckee, of course, with Austan Goolsbee. And Mike asked Austan Goolsbee, if we were to get another report like this on November 1st, is it possible that the Fed could hold? And of course, Chicago Fed President Austan Goolsbee didn't quite answer that question. But what's your view?
Yeah, I mean, I think at this point, the broader thing that we've been very focused on is just that, again, this economy is looking more normal versus any time since the pandemic, whatever kind of normal is, with the exception of monetary policy, which is elevated. And we think under a range of scenarios, there is still room for them to cut relative to where they are now. So our take on this is that, just some of the downside risks in the Fed funds rate, i.e., kind of those probabilities of other 50 basis point cuts, those I think have been, taken off the table or moderated more recently, and kind of a more gradual or sequence of 25 basis point rate cuts, seems very reasonable to us. This takes some of the urgency out of it, but doesn't take away the fact that monetary policy is still tight, and we have a more normal economy. So monetary policy still needs to be recalibrated to some extent.
Tiffany, something I'm interested in is watching the surge in yields across the board, the 10-year flirting with that 4% level once again. And if you don't see that more drastic pace of rate cuts, then how do you think about where the economy is most impacted and what the ripple effects are? There are plenty of people, Apollo's Mark Rowan, now Stanley Druckenmiller, saying financial conditions are really easy at the moment. We don't need that many rate cuts, but there's certainly parts of the economy that are feeling it.
Yeah, so I think absolutely. I think there is a key question here in terms of the outlook, which is how does the economy respond as the Federal Reserve starts to cut interest rates? And you have some indicators which suggest that maybe it doesn't respond that much. And that's because consumers still there's a big glut of mortgages consumers are paying interest rates that are well below the current coupon. So that would suggest that the Fed would need to drop rates by a lot in order to get any sort of stimulative pressure. But then there are other areas that we look at, where we think that, housing market, real residential investment, could pick up as you have interest rates that are lower. So I think this will be a key question moving forward. And this is ultimately why the Federal Reserve is not dropping interest rates back to neutral overnight. They don't know where neutral is. They're going to feel their way to it as they drop. And again, we think a sequence of rate cuts to try to, get a better understanding for the economy and the underlying levels of these, neutral interest rates is the way that they'll go about it.
Well, to that end, I'm glad you brought that ripple effect forward here, because a lot of what I've been wondering about is that feed through less severe than it was pre-2008, pre-2020. If the mortgage market, for example, is not really led by the banks anymore, then how quickly do you have the Federal Reserve cutting rates and then heading into those critical sectors that matter the most for consumers? Do rates really not move the needle on those sectors?
Yeah, I mean, I think for the consumer, I think the consumer is definitely less interest rate sensitive to interest rates. And again, that's because they were able to lock in low mortgages right after the pandemic overall. Now, of course, some consumers did not, and we will get some refis as a result of that. But we do have just a historically large pool of mortgages that are well under the current mortgage rate. So I think that's made consumers less interest rate sensitive overall. But, again, and so this might not really accelerate, consumer behavior, but at the same time, we just don't think the consumer looks that terrible. Sure, the low-end consumer is definitely, struggling here under higher prices, but overall, we think the consumer, looks pretty good. So it's not really the consumer that, would concern us more broadly about the economy.
So this is similar to the conversation we were having with Rick Rieder, of course, at the top of the 9 a.m. hour, that basically this is a services-led economy. And as such, similar to what you're saying, that interest rates, they don't matter as much to this economy than maybe in past cycles. How has that changed how the Federal Reserve makes policy, of course?
Well, I mean, I think the Fed, it just suggests there's not an urgency. And I think the Fed historically and central banks historically have not been very good at forecasting a recession. But they have been very good at telling when a recession is happening. And they drop their interest rates very quickly when that happens. The Federal Reserve right now is operating a little bit differently. They are trying to drop rates, ahead of any potential weakness. So we still think they will be very reactive. If the economy is starting to look weak, they'll be more reactive, and as of right now, they're probably on still the pace to cut interest rates here because they want to preempt any sort of weakness, buffer the economy for that, and really stick the soft landing.
All right, Tiffany, it's always great to speak with you. Get your insights on this jobs report. That, of course, is Tiffany Wilding of Pimco. Meanwhile, a quick check on markets because stocks giving back some of their gains right now. The S&P 500, it's still green, but less so, up about 0.3%. Big tech, same story, up about 0.4%. Meanwhile, that bond market sell-off just continuing. Now coming up, big tech turning to carbon-free nuclear energy to power data centers. We'll speak to the CEO of Energy Fuels next. This is Bloomberg.
We are just 32 days away from Election Day, with a number of political factors still in play. Joining us to talk about them, Joe Mathieu, co-anchor of Balance of Power in Washington. Gotta start with the news of the day, this port strike being averted in a big way. How much uncertainty does that take away for the Harris campaign in the next couple of weeks?
Well, it's more about how long the uncertainty is being taken away for, and that is straight through the election. So this is a pretty big win as it's being seen for the Harris campaign, for the Biden administration, even though the job is only half done. They've got a deal on wages here, but they have to come back around for a deal on automation. They've got past the election to deal with that, and it probably won't be in the news a lot as talks continue between now and then. But this jobs report today is interesting. You were talking to the acting labor secretary professing the benefits of collective bargaining, and that's exactly what Joe Biden was talking about and Kamala Harris in their statements about the end of the dock workers strike. And it shows up again today in Joe Biden's statement on the jobs report. Normally, he's talking about jobs created, and he does that in this case. He says more work needs to be done, but he talks about the power of collective bargaining to lift up workers' wages, including, he says, the progress made by dock workers. They're trying to stitch these two stories together here as the administration and the campaign try to embrace the idea of a soft landing.
Absolutely. Of course, taking a victory lap there, the administration. And we did hear the phrase collective bargaining a few times from Acting Labor Secretary Julie Su.
Yes, you did.
I did indeed. I do want to talk, though, about the details of this jobs report, this coming from Mckee, that you take a look at white unemployment, the rate there, the unemployment rate fell. But when it comes to black unemployment, the rate fell from 6.1% to 5.7%. Hispanic unemployment fell from 5.5% to 5.1%. So the details here are really good, too, when you think about the platform, the economic policy portfolio that Kamala Harris is trying to build.
Well, that's absolutely right. And remembering it was just a couple of months ago that Donald Trump was gaining ground specifically among young black men, among young Hispanic men. He talks about it in his stump speech. He talks about how he created the best job market ever for African-American citizens in his first term, and he wants to extend that to another. But yes, this is cutting into his narrative, and it's fulfilling what we're seeing in a lot of polls about these communities shifting in favor of Kamala Harris. So that's what you're going to be hearing about in the stump speech when she starts to hit the road. By the way, with Barack Obama starting next week, he just signed up for a month on the road. Series of events for the Harris campaign.
Well, one of the early places that he will be visiting, of course, is Pennsylvania, a big swing state where we know Trump will also be over the weekend. Elon Musk as well, helping him in that state. And it comes down to energy policy. Joe, it's interesting. You look at these overall numbers, you wonder how they feed into the way Americans feel about their jobs, and also just how certain areas matter more than others when it comes to the vote. What is going to matter when they reach the campaign trail?
They're going to start. Look, by the way, Barack Obama you're right, he's starting in Pittsburgh. That's next Thursday. And this weekend, Donald Trump goes back to Butler, Pennsylvania, the site of the first attempted assassination. And yes, he's going to have Elon Musk in tow. He says he'll be there to support Donald Trump. I do wonder if he speaks at that rally. Donald Trump's known for calling people up on the stage, and that would kind of bring a new contour to this race, knowing that Elon Musk, I guess, has every right to be there. He's funneling $71 million of his money through a super PAC to support Donald Trump's ground game in places like Pennsylvania, where this is a 1 or 2 point race, depending on the poll that you're looking at. So, yes, you factor in Pennsylvania, Michigan, but also the two states that have been impacted by Hurricane Helene. We've got our eyes on North Carolina and Georgia. The candidates have been there this week and will be returning to those states impacted by the storm. The recovery effort, the way this is handled, could actually have a really meaningful impact on the campaign with regard to the incumbent.
Right. Pennsylvania important for so many reasons. But talk to us about the significance that Elon Musk is joining Trump in Butler, Pennsylvania, of course, the site of the first assassination attempt on former President Donald Trump.
Well, significant just because we've got a larger-than-life personality here who's funneling millions of dollars into Donald Trump's campaign and happens to control one of the most important public squares in the digital media space. Whether he plays a larger role, look, Donald Trump wants him to play a role in an administration if he's reelected. But they're both keeping company with bold faces. Kamala Harris with Liz Cheney, of all people, last evening at the birthplace of the Republican Party in Wisconsin, who told the crowd she's been a Republican since before Trump started spray tanning. She got a laugh line on that one. Also, an endorsement today from Bruce Springsteen. When you add that to Taylor Swift, I don't know, guys, maybe this is the battle of the celebrity endorsements in the end.
I actually put that in our internal chat that Bruce Springsteen has endorsed Kamala Harris, and one of our producers makes the good point that I don't think that they were going to lose New Jersey. Joe Mathieu joining us from Washington. Thank you so much, of course. Let's turn back to these markets now. Of course, an interesting picture if you take a look at the S&P 500. Of course, green on the screen, but just so. You take a look, the S&P 500 currently up about 0.1%. We were looking at gains of nearly 1% earlier, but of course that coming back ahead of the weekend. You take a look at the NASDAQ 100, same story with big tech. Meanwhile, the bond market continuing to sell off. Let's try to make sense of it now with Bloomberg's Denitsa Tsekova joining us from the cross-asset team. What is the reaction that you're seeing when you talk to your sources, from investors to analysts to strategists, about the reaction to this labor market report?
I think it's a very delicate balance of economic data, positioning, and market expectations. And we're definitely seeing that play today. We saw the initial reactions, but we see some concerns that have been there for a very long time show up. We see valuations. Valuations have been elevated for quite some time. So with indices close to or at record high, it's much harder to be too excited about this. Of course, economic data has been so hard to predict for such a long time. You see today, obviously, economists have been, again, really surprised by the results. But the problem is, hotter jobs number, we start talking about inflation again. Obviously, things have been moving in the right direction for quite some time, but now people are worried about striking that perfect balance, and this all comes on top of very heavy risk on positioning. So definitely investors have a lot of more pressure to consider where to limit that risk.
I love the conversation about positioning. This week, one of the big market makers told me that only half of the market consists of people, investors that he could talk to, because it's all quantitative, it's all high frequency. And you saw that knee-jerk reaction in the bond market in particular. So when you look at these kind of drastic moves, and if you're an investor, where is equilibrium? I mean, how much of it is a give back at the end of the day?
Yeah, for sure. Technical forces have been a really big factor. We saw what happened on August 5th. Generally, on every day when the moves are a little bit bigger, like 1, 2 standard deviations, there is for sure technical factors playing in. We also have seen an interesting balance between the stock and the bond market, right? They disagree significantly about whether we're going to see a recession or not. So we've seen that debate of like, are stocks right? Are bonds right? Potentially earlier in the morning, it looks like stocks are right. But there is a lot of pressure. We saw that significantly expectation about rate cuts are now reduced. But even with that in mind, we already saw 50 basis points. So it's a really difficult place between market expectations. Any surprise can make significant moves. Positioning is very extended, and those technical factors can have a much bigger impact when the daily move is big.
Yeah, it's been fascinating watching investors try to thread that needle, particularly in the bond market. I mean, it seems like a lot of traders were caught off sides this morning. That's why you have 10-year yields knocking on the door of 4% or so. Let's go under the hood in the equity market, though, because we do have some really interesting moves, especially when it comes to the airlines.
Yeah, we're seeing a very interesting moves in the airline space. If we look at United, it was up 6% on the day. We saw similar moves in Delta, Southwest, and it all goes back to that FAA review that actually found no significant risks in the airline. We actually know that Southwest is under similar review, so perhaps the industry is taking cues from that review and is optimistic about the outlook. Of course, one of the accidents was the plane taking off and one of the wheels falling after takeoff. There were quite a few that made the news, of course. That said, the United is up 40% year to date, and the latest move is definitely giving it a little bit of boost.
One more to keep an eye on as well, and it's kind of amazing. There was also that Spirit deal this morning. I just want to point that out because it's just taking such a tanking, guys. 25% lower today, struggling to reach a rescue deal. Frontier up 20%. I mean, you also have some of the competitive pressures here, moving from one airline to another potentially. Really quickly, want you to also keep us posted on Rivian here. Had a drastic move, was pretty volatile this morning.
Yes, it fell almost more than 9% in pre-market. Now the losses are a little bit smaller, but nevertheless, the year-to-date losses are close to 60%. The company is struggling a lot. Of course, today we saw the news about production. It's expected to drop as much as 18% this year. And this just comes on top of so many bad news in terms of supply chain. And of course, there is the broader slowdown we're seeing in the EV market, and that's definitely weighing on the stock, which is under a lot of this pressure.
Right. It's pretty amazing moves there. Of course, it's been a heavy week of EV news. Bloomberg's Denitsa Tsekova, thank you so much. Now, coming up, as we mentioned, big tech turning to carbon-free nuclear energy to power data centers. We'll speak about it with Mark Chalmers. He is Energy Fuel's president and CEO. Next. This is Bloomberg.
This is Bloomberg Open Interest, and you're looking live at the Principal Room. Coming up, an interview with Vinod Khosla, founder of Khosla Ventures, today at 11:30 a.m. New York time. This is Bloomberg.
All right, it's time now for our daily Wall Street Week conversation. And investing in art can be just as daunting as understanding equity or bond markets. David Weston spoke with Phillips executive chairman and CEO Edward Dolman about how the art auction industry has changed over the years.
Well, it's been transformed, actually, in the time that I've been in it, which is a long time now, it's 35 years. When I first started, the market was opaque, to say the least. The only people who had any pricing information were the auctioneers and the dealers who attended the auctions and wrote down all the prices in their catalogues. It was sort of impossible for anybody outside that community to understand how much things were really worth and what the market was and who was in the market for these things. And I think the biggest transformative event in our world has been information and access to data. You know, I often think the market of the last 20 years has been driven by, in a way, the creation of the ArtNet database, this one entity that came to the fore in the 1990s that suddenly gave people a reference point for what was going on in the marketplace. And that drove an interest and a confidence in approaching the market. So really, the market we see now, what's so different about it is the access to information that everybody has who's in that room, competing, whether they're in Asia or South America or Europe or America. They have access to the same information.
How much of the art business more broadly is public and how much is private we never hear about?
I don't think anyone knows specifically, but I think there is a report created every year by the TFAF Fair out of Maastricht. I think the numbers are something like sort of 60% of the market is actually private, 30% of it is public at auction, something like that. But certainly the majority of the business is done outside the public auctions.
Has the nature of the people bidding at your auctions changed over time?
Yes. When we go back to that world I was describing earlier, where it was fairly closed, information wasn't shared, it was the dealers effectively buying in the auctions and then selling on to their clients. Now, the auctions are populated by everybody, dealers, collectors, but mostly private collectors dealing with their advisors, which is a new group of professionals working in our space now who've blossomed and exploded in terms of numbers over the last 15 years. And these advisors are now pretty important in our world.
Who are the people who become advisors and what do they advise on?
Well, they're often ex-auction house employees, people who've been in the market, who understand the market. Quite often they've worked for dealers, big dealerships, because in the time we're talking about, the dealers have transformed their game as well and have become these huge international mega galleries. And so people have come through the auctions, come through these large galleries, and that they then tend to meet 2 or 3 clients in that journey.
And that was Phillips executive chairman and CEO Edward Dolman speaking to our own David Weston. And of course, you can catch Wall Street Week every Friday at 6 p.m. Eastern. Now we want to turn to one of the other big stories in this market, and that is big tech continuing to search for its power needs for data center. You had the CEO of Google saying that his company is considering buying electricity from nuclear power plants as a solution. And that news helping to power the already surging nuclear and uranium market. Joining us now is Mark Chalmers. He is Energy Fuels president and CEO. And Mark, of course, has over 48 years of experience in the global uranium industry. And Mark, with that in mind, of course, your tenure in this industry, talk to us about this moment. Give us the context about how the excitement that we're seeing around uranium and nuclear right now compares to the past 50 years or so.
I've never seen anything like it. As you said, 48 years is a long time, 2/3 of the nuclear fuel cycle. I've been in the business, and the bipartisan support for nuclear power, carbon-free, globally is just increasing by the day, and certainly the addition of the energy demand from data centers is just extraordinary.
You know, it's interesting. There has been so much conversation about the biggest tech companies looking to nuclear energy at this juncture, potentially for those data centers. What are your conversations looking like under the surface? What types of companies are you speaking to, and what is the velocity of that conversation?
Well, I mean, I think again, it's just universal around the globe that people are recognizing that they need baseload carbon-free power 24/7, and I think that what you're seeing, and I think one of the things is the stigma with nuclear power over decades has really held back nuclear power, but now people are appreciating that they need their data. And I think young people are appreciating they're going to need their data. And so they see these moves by companies like Microsoft and Google looking for nuclear power to support these data centers. And I think that, again, in itself is extraordinary and has a material ability to move the market forward even greater in the future.
And I am curious, I mean, with all this energy back in the space, not to use a pun or anything, and all of these partnerships happening, I'm wondering if you see any consolidation and whether you would be open to potentially merging with another company here.
Well, our company is slightly different because we bolted on the rare earth element story to our uranium production capability. But yeah, I think that mergers, acquisitions, consolidation is just natural in an up market. We're not actively looking for some consolidation ourselves. Actually, we just acquired a company in Australia. I'm in Perth, Australia today, and 3 days ago, we actually acquired a company that's heavy mineral sand that also has projects that have substantial quantities of rare earths. So, but for our company itself, we're not wanting to be acquired, but we just acquired a company 3 days ago, closed Base Resources, an ASX-listed company in Australia.
Well, there you have it, and we really appreciate you staying up late for us. Of course, that is Mark Chalmers of Energy Fuels. Meanwhile, we have to go back to these markets. A lot of movement right now. You take a look at the S&P 500. Really giving back most of its big gains, of course, but still managing to hold on to green territory right now, up about 0.3%. You take a look at the NASDAQ, currently up about 0.6% when it comes to your big tech names. Interestingly, the bond market has been consistent all morning, holding on to that sell-off. Yields currently about 11 basis points higher when it comes, of course, to the 10-year Treasury yield.
And it's fascinating. You see traders really wiping out that potential for even 25 basis points. So drastic moves in the bond market, almost 17 basis points higher on that 2-year. Just incredible, Katie. But I want to turn now to a story that you've been keeping an eye on. Love this story. There's a supply crunch brewing somewhere you wouldn't think. In the single stock ETF world, issuers are looking to snap up catchy tickers to draw investors. Research shows that stocks with tickers that are actual words tend to benefit from lower spreads and greater liquidity. Katie, you're reporting on this. We were talking a little earlier about how we like statistics. We like probability. How many tickers are even out there in the world and how many are taken?
Yeah, I had to do math for this story, which isn't my favorite thing to do. I checked this number a few different times, but if you take a look at U.S. exchanges, there is a 4-character limit for your tickers. That produces probably an infinite, realistically, number of combinations, about 500,000. But if you boil it down to the world of single stock ETFs, of course, the ticker that you would pick for your fund has to be connected to the underlying stock's ticker. So if you take a look at MicroStrategy single stock ETFs right now, and there's a couple of them already on the market, they have to devote 3 characters to MST. That leaves you 1 character of real estate, and that really only gives you about 52 realistic combinations. These are very, very popular funds. So I have a lot of issuers telling me that this is only going to become worse and worse, that these supply woes, if you will, are just going to become more of a pressure cooker.
Dumb question.
No.
Does this only apply to the ETF world? Because if you're a company going public, you want a good ticker.
Exactly. I mean, you think about some of the companies out there and the exchanges and speaking with them. We spoke to Jeff Thomas from NASDAQ, for example, on this program, who said he's not worried about a ticker shortage at all when you look at the broad universe of 4-character symbols. But for ETFs, for actual companies that are all coalescing around a similar theme, that's where it becomes a little bit more dicey, where you really have to be quick, where you have to be creative, and in some cases you have to actually hoard and stockpile a ticker.
And this is what you're writing about today, aren't you?
Yeah, exactly. So I spoke to some issuers, of course, of single stock ETFs, and Matt Tuttle, for example, he told me that he's actually just sitting on about 20 tickers right now. He's reserved them with exchanges. Doesn't necessarily have fund ideas to match the ticker yet, but some of them are really good. He has DUM on reserve, he has DUMP on reserve, and he's just waiting for an opportunity, an idea to do that. But again, he's hoarding, and so that creates frustrations among the other issuers as well.
Katie's being shy. Read her newsletter. Read mine too. We both publish on Fridays. Also, your colleagues, our colleague over at Bloomberg Intelligence, Eric Balchina, said ETFs globally took in $477 billion in the third quarter, crushing the old record by 30%.
Yeah.
There's a lot going on in this market.
It's wild. I mean, it's a real follow the money story, and all of the money is going into ETFs increasingly. I mean, if you take a look at the flow of funds between mutual funds and ETFs, it's like a zero-sum game, basically. You have hundreds of billions of dollars, trillions of dollars really leaving mutual funds, going into ETFs over the past decade, and that's why you're seeing all of these funds launch, which leads us back to this ticker shortage. And of course, you have issuers, potential issuers, such as Apollo, for example, as you reported, pairing up with State Street, trying to fit private assets into ETFs. So that's the stage of the industry that we're at. How do we fit basically everything into the ETF wrapper?
Well, also the liquidity profile of them, I think that's very interesting too, because that liquidity that you get behind those ETFs begets more liquidity, if you will. Didn't we reach the milestone this week on assets?
Yeah, I mean, in the ETF universe, at least in the U.S., you're above $10 trillion in assets.
That's Blackrock.
It's wild. I mean, Blackrock controls about $3 trillion of that. So BlackRock, of course, the big dominant player there. Vanguard, too, just a few $100 billion shy of that BlackRock mark. But you can read and watch more about ETFs, of course, in the newsletter on ETF IQ every Monday at 12 p.m. Eastern. But we have to talk about markets right now, Sonali. You take a look at the digestion of that jobs report not going over too smoothly. Again, we had this big pop to start the trading session, now coming back a little bit as maybe traders take some risk off going into the weekend. The S&P 500, it's still up about 0.3%, still up about 0.6% on the NASDAQ 100, and the bond market, that sell-off just continues.
You have to wonder if that 10-year hits 4% again. We are so close. We were even closer earlier today. The reversal in the NASDAQ 100 seems a little bit more significant. It's not a full reversal. We're still up by 0.6%, but we lost a lot of ground today. We were up well over 1% earlier.
Yeah, big time. And that's, of course, what's dragging down the S&P 500 when you think about just the weighting of those big tech heavyweights. We'll have to follow all of that, of course, going into the close. But that does it for Bloomberg Open Interest. We have a great week coming up next week, of course. You take a look at our C-suite lineup, KBW to Priceline to NASDAQ. You won't want to miss it. Have a great weekend. This is Bloomberg.